99% of traders lose money. That's a hard truth, but it's one every man who steps into the market must face before he puts down a single dollar. The market doesn't owe you a living. It doesn't care how smart you are, how many charts you've memorized, or how sure you feel about the next move. It only rewards the man who understands himself as much as he understands the tape. And that's what we're talking about today. You might remember in the previous video on Improve Your Trading Accuracy, we spoke about sharpening your entries and reading the tape like a seasoned hand. Well, today we go a step deeper, into the mindset and methods that separate the 1% who survive from the rest who fade away. Now, you might be wondering, why do so many traders lose when the rules of the game are right there in front of them? The answer's simple. Though not easy, they trade their hopes instead of the market. Most folks don't come to the market to trade. They come to gamble. They chase action, they crave excitement, and they want quick profits. But the market isn't a casino. It's a mirror. It reflects your discipline, your patience, and your weaknesses right back at you. Tell me, how many times have you taken a trade just because you were bored, or doubled down because you knew the price had to come back? That's how 99% lose, not because the market beat them, but because they beat themselves. The successful trader never fights the market. He doesn't predict, he observes. He doesn't react, he waits. I used to say, there's only one side to the market, not the bull side or the bear side, but the right side. And to find the right side, you have to train your eyes to read what the market is saying, not what you want it to say. Every tick, every swing, every pause. It's all information. The average trader looks at a chart and sees opportunity. The professional looks at it and sees risk. Do you see the difference? You see, losing traders try to force profits. They can't stand to sit still. The hardest thing in trading isn't pulling the trigger, it's waiting for the right moment to do nothing. You can be wrong a dozen times, but if you know how to wait for the real move and ride it, that one trade can make your month. Most traders never learn that. They get shaken out by noise, by fear, by impatience. They sell their winners too soon and hold their losers too long. Why? Because they don't trust their own judgment, or worse, they never developed one. You've got to remember, the market is never wrong. Your opinion is. When you argue with price, you lose every time. When the market tells you you're wrong, listen. Cut your losses clean. Take the small hit before it becomes a wound. I've seen men ruin themselves by refusing to admit a small mistake, and all because they wanted to be right instead of profitable. Do you want to be right, or do you want to make money? The 99% don't lose because they lack intelligence. They lose because they lack temperament. Trading is not a test of brains. It's a test of character. You can have the finest chart setups, the smartest indicators, and the best mentors, but if you can't master your own impulses, you'll still blow up your account. Every great trader learns this the hard way. The real enemy isn't the market. It's the man in the mirror. Now, if you recall from our earlier talk about improving your trading accuracy, we said precision isn't about prediction. It's about preparation. Today's principle is the natural extension of that idea. Accuracy helps you enter well. Discipline keeps you in the trade. Together they form the backbone of a sound trading method. You can't have one without the other. The 99% lose because they build their methods backward. They start with entries before they build character. There's another reason most traders fail. They're undercapitalized and overconfident. They risk too much on one trade, hoping for a windfall. They forget that survival is the first rule. If you blow up your account, you're out of the game. A trader's job isn't to hit home runs, it's to stay in the market long enough to let his edge work. The best traders don't look for excitement, they look for longevity. They protect their capital as if it were their life, because in this game, it is. Have you ever stopped to think that your main business as a trader is not to make money, but to keep it? And don't let anyone tell you otherwise. There's no secret formula, no magic indicator, no shortcut to mastery. Every winning trader goes through the same process: study, observation, patience, and 1,000 small mistakes. The tape teaches you if you let it. Every loss has a lesson, every gain a reminder. The problem is, most people never stay in the classroom long enough to learn. They quit too soon or start chasing new systems before mastering one. The truth is, you don't need 100 strategies. You need one sound method and the discipline to stick with it. When I was young, I thought trading was about catching tops and bottoms. I wanted to buy the low and sell the high, the perfect trade. But the longer I traded, the more I learned that perfection doesn't pay. The big money is made in the middle, in the meat of the move, after the trend has already shown its hand. Most traders can't wait that long. They jump in too early or hold too late. But the professional knows the market always gives you a signal. If you have the patience to wait for it, are you willing to wait? Another thing that separates the winners from the losers is emotional control. You can't afford to get attached to your trades. A trade doesn't care about your feelings, and neither should you. When you find yourself hoping, you're already in trouble. Hope belongs in church, not in the market. The market rewards the man who acts on facts, not emotions. And let me tell you something else. The reason most traders never build real wealth is because they don't treat trading like a business. They treat it like a hobby. They don't keep records, they don't study their trades, and they don't manage their money. The pros, on the other hand, run it like an enterprise. Every position is an investment in probability. Every dollar risked is capital that must be protected. They think in terms of percentages, not points, in terms of risk, not reward. That's how you build wealth in this game. Slow, steady, methodical. Remember this. You don't have to trade every day to make money. You just have to trade right when the opportunity appears. Most of the time, the market's job is to lure you into bad trades. Your job is to avoid them. Wait for the setup that's so clear it feels almost obvious. That's when you strike. Until then, keep your powder dry, because when you think about it, the 99% lose not because the market's against them, but because they're against themselves. They won't wait. They won't learn. They won't stop guessing. The 1%, the real traders. They understand that the market doesn't reward speed, it rewards patience. They know that wealth isn't built from one lucky trade, but from consistency over time. Most traders lose because they trade emotions, not the market. It sounds simple, almost too simple, but that one sentence explains more blown accounts than any complex strategy ever could. The moment a trader lets fear or greed make the decisions, he stops being a trader and becomes a gambler. The market doesn't punish intelligence, it punishes emotion. And the cruel part is, the market knows exactly how to make you feel what it needs you to feel before taking your money. It lures you in with hope, shakes you with fear, and breaks you with impatience. The tape is just numbers and movement. It's the trader who gives it meaning, who breathes emotion into every tick. You see, the average trader comes into the market with dreams of freedom, fast profits, and that rush of being right. They start out believing they'll outsmart everyone else, that they'll pick the perfect entry and ride it to glory. But when the market turns against them, as it always does at some point, they don't see price, they see pain. They don't act on facts, they react to feelings. Tell me, have you ever moved your stop just a little further because you knew the market would turn back, or hesitated to close a losing trade because you couldn't bear to lock in the loss? That's emotion talking. And emotion has no mercy in the market. When you trade on emotion, you're no longer trading what the market is showing, you're trading what you want to see. Hope becomes your indicator, and fear becomes your risk management. The market moves in patterns, but emotions move in impulses. Sharp, unpredictable, and irrational. That's why the 99% keep losing. They're not reading the tape. They're reading their feelings. A chart pattern doesn't cause loss. The trader's inability to control his reaction does. The successful trader approaches the market like a surgeon approaches the operating table. Calm, focused, detached. There's no room for excitement, no space for panic. Every decision is made on evidence, not emotion. He studies the tape, reads the price action, and acts only when the market confirms his setup. He knows that once he's in a trade, the outcome is no longer in his hands. All he controls is the risk, the exit, and his own behavior. The rest belongs to the market. But emotional trading doesn't start when you click buy or sell. It begins long before, in how you think about money, loss, and success. Most traders have a distorted relationship with money. They see it as validation. When they win, they feel powerful. When they lose, they feel defeated. That's dangerous, because it ties your self-worth to your trading results. The market doesn't care about your ego. It doesn't reward effort or punish laziness. It simply reflects probability and psychology. The trader who understands this stops taking losses personally. He sees them as part of the cost of doing business. The emotional trader, on the other hand, takes every loss as an attack, every drawdown as a failure. He fights the market, and the market always wins that fight. Now think about what happens when greed enters the picture. Greed whispers that the move isn't over yet, that you can squeeze out just a little more profit. You've seen it. The price runs in your favor, you're up nicely, but instead of taking what the market gives, you hold on, convinced it'll go higher. Then it reverses, wipes out your gains, and suddenly you're staring at a losing position. That moment of greed turns a winner into a loser, and what follows greed? Regret, revenge, and desperation. That's how accounts get destroyed. Emotional trading also leads to overtrading. When a trader feels restless or anxious, he mistakes activity for progress. He starts taking trades just to feel in control. The irony is, every emotional trade makes him more out of control. The calm trader knows that opportunities come and go like waves. You don't chase them, you wait for the right one. The emotional trader jumps at every flicker of movement, and the market uses that impatience to take him apart piece by piece. The worst part about emotional trading is that it feels right in the moment. Fear convinces you that selling early is smart. Hope convinces you that holding longer is wise. Greed tells you to double down because this one can't fail. And before you know it, logic has left the room. The mind starts working to justify what the heart has already decided. Every losing trader knows that sick feeling. The one that comes when you realize you didn't follow your plan. You knew what to do, but you didn't do it. And that's the mark of emotion, not strategy. If you want to stop trading emotionally, you must first accept that emotions never disappear. You can't eliminate fear or greed, but you can control how you respond to them. That's where discipline comes in. Discipline isn't about being rigid, it's about being consistent. It's what keeps you from chasing noise and teaches you to trust your process. The disciplined trader may still feel anxious or excited, but he never lets those feelings dictate his actions. He has rules, and he sticks to them, even when it hurts. Especially when it hurts. Another way to keep emotions out of your trades is to limit your risk. The smaller the position size, the less emotional weight each trade carries. If losing a trade makes you angry or nervous, you're trading too large. A trade should never shake your peace. The moment you feel panic, the market already has control over you. Reduce the size, tighten the plan, and trade only when the setup aligns with your edge. Most traders lose because they refuse to be bored. They crave excitement, and excitement breeds emotion. The best trades are often the quiet ones, the ones that feel almost too calm, too slow. But that's where discipline thrives. Trading isn't about constant action, it's about waiting for precision. When you understand that, you start to see the market differently. You stop reacting and start observing. The tape is neutral. It has no emotion. It moves because of supply and demand, not because of your feelings about it. Your only task is to interpret that movement clearly, without bias. But the moment you bring in fear, hope, or greed, your vision clouds. You start seeing what you want to happen instead of what is happening. Discipline outweighs intelligence in trading success. Most people think trading is about being clever, about figuring out some secret the rest of the world hasn't seen yet. They think if they can just find that perfect strategy, that flawless indicator, that magic setup, they'll finally beat the market. But the market doesn't reward cleverness. It rewards consistency. I've seen plenty of smart men lose fortunes in the market, and I've seen ordinary fellows with steady habits make a lifetime of profits. The difference between them wasn't intellect, it was discipline. The disciplined trader survives, the undisciplined one always ends up paying for his lessons. You can read every book, watch every chart, study every pattern, but if you can't follow your own rules, none of it matters. The market will expose every weakness in your character. It doesn't care how good your analysis looks on paper if you don't have the patience to wait for your setup or the self-control to cut a losing trade. Intelligence can tell you what should happen. Discipline is what keeps you alive when it doesn't. How many times have you told yourself you'd follow your plan? This time, only to break it the moment a trade moved against you. That's not a lack of knowledge. That's a lack of discipline. Discipline is the backbone of a trader's success. It's not glamorous, and it doesn't give you a rush. It's quiet, steady, sometimes boring, but it's what separates the professional from the amateur. The disciplined trader knows that every trade is just one of many. He doesn't fall in love with his setups or panic when a position goes wrong. He manages risk, follows his rules, and keeps his emotions in check. The undisciplined trader, on the other hand, treats every trade like it's life or death. He rides the highs too high and the lows too low. He makes emotional decisions, not logical ones, and the market takes advantage of that every time. People often mistake discipline for rigidity, but they're not the same. Discipline isn't about stubbornly sticking to a bad plan. It's about sticking to a tested one. It's the ability to do the right thing, even when it's uncomfortable. Most traders can be disciplined when things are going well, but what happens when the market turns? What happens when 3 losing trades come in a row and your confidence starts to shake? That's when discipline shows its real value. Intelligence might tell you to double down and make it back. Discipline tells you to step back, reassess, and protect your capital. You see, intelligence in trading is easy to come by. Anyone can learn how to read charts, understand trends, or analyze economic data. But very few can master their own behavior under pressure. The moment real money is on the line, logic takes a back seat. The only thing that keeps you steady in those moments is discipline. The habit of following your plan no matter how you feel. Do you see how rare that is? The average trader wants to feel confident before acting. The professional acts according to rules, not feelings. Discipline is also what protects a trader from overtrading. The undisciplined trader can't stand still. He thinks constant action means progress. He trades to feel productive, to stay in control. The disciplined trader understands that waiting is part of the job. He can sit through dull markets without forcing trades. He doesn't need the market to move every minute. He waits for clear signals, and when they appear, he executes without hesitation. Discipline teaches you that there's power in patience, that doing nothing is often the smartest move. And let's not forget, discipline starts long before the trade. It begins with preparation. It's in how you plan your day, how you review your charts, how you define your risk before you ever enter a position. Most traders lose not because they made a bad trade, but because they had no plan to begin with. The disciplined trader knows exactly how much he's willing to lose before he clicks the button. He doesn't negotiate with himself after the fact. The undisciplined one enters first and thinks later. He hopes instead of plans, and hope is a dangerous strategy in the market. There's also the discipline of record keeping, the boring part most people skip. Every serious trader keeps a journal, not for the sake of nostalgia, but for learning. They record their trades, their reasons for entering, their emotional state, and the results. Over time, patterns emerge, not in the market, but in their own behavior. They can see when they broke rules, when they overtraded, when they let emotion take over. The undisciplined trader doesn't bother. He blames bad luck, market manipulation, or timing. He never looks inward, and so he never grows. Discipline is what allows you to think clearly under stress. The market can move fast, and without self-control, you'll get swept away in the noise. When panic spreads, the disciplined trader stays calm. When greed takes over the crowd, he stays cautious. He doesn't follow the herd, because he's trained to trust his process. The disciplined trader doesn't chase moves. He lets the market come to him. He knows his edge and waits patiently for it to appear. If intelligence were enough to win in trading, universities would be filled with millionaires. But trading isn't an intellectual contest, it's an emotional one. The smartest trader in the room can still lose everything if he lacks control. The disciplined trader, even with modest skill, can thrive because he knows how to protect his capital and stay consistent. Intelligence might help you understand the market, but discipline ensures you survive long enough to profit from that understanding. And it's not just about following rules. It's about building habits. Every time you act with discipline, you strengthen your control. Every time you break your rules, you weaken it. Over time, discipline becomes part of your identity. You start to value restraint over excitement, patience over impulsiveness. You stop chasing trades for validation and start trading for longevity. That's when real progress begins. The truth is, discipline doesn't feel like success in the moment. It often feels like restraint, like missing out, like sitting on your hands while others celebrate quick wins. But those quick wins fade, and the undisciplined trader always gives them back to the market. The disciplined trader, though, keeps building, trade by trade, day by day, slowly, steadily, without drama, because in the long run, it's not the smartest trader who wins. It's the one who can stick to his plan when everything in him wants to do the opposite. Patience to do nothing is a trader's greatest edge. It sounds simple, even dull, but that quiet restraint is what separates the true operator from the restless amateur. Most traders lose not because they can't find good setups, but because they can't wait for them. They feel an itch to be in the market at all times, as if action itself were progress. But the market doesn't pay you for activity. It pays you for accuracy. And accuracy only comes when you've got the patience to sit still until the odds line up in your favor. Every professional trader learns this truth the hard way. You start out thinking trading is about constant movement, buying, selling, reacting to every tick. You convince yourself that if you're not in a trade, you're missing out. But soon you realize that most of your profits come from a handful of trades, while the rest are just noise. The irony is that the best trades often come when you've been doing nothing for days, maybe weeks, just watching the market form a setup. The waiting is what gives you the edge. It lets the market reveal its hand, while everyone else gets shaken out by impatience. The average trader can't handle that kind of stillness. He feels the market moving and thinks he's falling behind. He wants action, and the market knows it. So it tempts him. A small move here, a breakout there, and before long, he's in a trade without a plan, just because he couldn't bear to wait any longer. Tell me, how many times have you taken a trade simply because you were afraid of missing out? That's not strategy. That's emotion disguised as decision-making. Patience would have told you to wait for confirmation, to let the price prove itself. But impatience whispers that if you don't act now, someone else will take the profit. That whisper ruins traders every day. You see, the market rewards those who can wait for high probability conditions. A patient trader doesn't try to predict what will happen. He waits to see what's happening. He lets others guess and gamble, while he studies the tape quietly. He knows that timing is everything, and timing comes from observation, not prediction. The impatient trader wants to control the market. The patient trader lets the market lead. One fights the tape, the other follows it. That's why one survives and the other doesn't. Patience is not passive. It's an active discipline, a kind of mental stillness that takes effort. It means watching the market without reacting, analyzing without forcing trades, sitting through boredom without giving in to temptation. Most people can't do it because they equate inaction with weakness. They think a trader's job is to trade, but a professional's job is to wait, to conserve energy and capital until the opportunity is clear. The great moves, the real money, come when the conditions align perfectly, and that alignment doesn't happen every day. Patience also protects you from over-trading, which is one of the silent killers of trading accounts. The more trades you take, The more you expose yourself to random noise, to slippage, to mistakes, each unnecessary trade drains your focus and your confidence. The patient trader, on the other hand, conserves both. He knows that trading is like hunting. You don't fire at every sound in the woods. You wait for the clean shot. When you act too often, you lose precision. But when you wait for the right moment, your strike counts. The hardest part about patience is psychological. The market doesn't just test your analysis. It tests your temperament. It knows how to make you doubt your plan. It moves just enough to make you second, guess your discipline, to make you believe a small breakout is the start of something big. But if you've been around long enough, you learn that most of those early moves are traps. The patient trader avoids them. He waits for confirmation, for volume, for conviction in the price. He's not worried about missing the first 10% of the move. He wants the middle, the part that's clear and sustainable. And patience doesn't only apply to entries. It applies to exits too. Many traders ruin perfectly good positions by closing them too early. The moment a trade shows a little profit, they jump out, afraid it'll disappear. They can't sit through normal pullbacks, so they cut winners short. The patient trader rides the wave. He understands that trends need room to breathe. He doesn't panic when the market wiggles. He trusts his plan. That patience allows him to capture the real move, the one that pays for all the small losses along the way. If you think about it, patience is really a form of confidence. You can only wait when you believe in your method. Impatient traders don't trust their system. They need constant feedback to feel secure. But confidence gives you the strength to wait quietly, knowing your edge will show itself in time. That's why patience and discipline go hand in hand. One without the other can't last. You can't be disciplined if you can't wait, and you can't wait if you don't believe in your process. Every great move I ever caught came after a long period of waiting. Weeks of nothing, just observation, small false starts, and silence. Then suddenly the setup appeared, the tape confirmed, and everything lined up. The move felt almost inevitable. But that moment only came because of the patience before it. If I had been busy chasing noise, I'd have missed it entirely. That's what most traders never understand, that the waiting is the work. The sitting, the studying, the observing. That's what builds the edge. The trade itself is just the execution of all that waiting. Patience also builds emotional stability. When you learn to sit through slow markets without forcing trades, you train yourself to stay calm under pressure. You stop needing the market to entertain you. You stop chasing excitement and start valuing precision. The patient trader doesn't need to prove anything. He knows that opportunities are endless, but capital is limited. Every trade he doesn't take is one more bullet saved for the right moment. Think about how the professionals behave. They're not glued to every tick. They know the market moves in cycles, fast, slow, chaotic, quiet. They wait for their kind of market, their kind of setup. They can sit through stretches of inactivity without losing focus or confidence. That's patience in its purest form. Knowing that doing nothing is often the smartest thing you can do. The amateurs burn themselves out chasing movement. Trading accuracy means preparation, not prediction. That's a lesson most traders never learn until the market teaches it to them the hard way. Everyone wants to predict where the next big move will happen, but the market doesn't pay profits. It pays professionals. Accuracy doesn't come from guessing right, it comes from being ready when the opportunity appears. The trader who prepares thoroughly, who studies the chart, the levels, the volume, the context, that's the one who seems lucky. But it isn't luck. It's readiness meeting opportunity. Most traders get accuracy backward. They think accuracy means calling tops and bottoms, catching every move, being right all the time. So they chase every signal, every headline, every rumor. They pile indicators onto their charts until they can't even see the price anymore. But the truth is, real trading accuracy is about clarity, not clutter. It's about knowing what not to trade. The professional knows that most setups aren't worth touching. He filters ruthlessly. He waits for alignment, price, volume, trend, sentiment, all pointing in the same direction. And when that alignment appears, he acts swiftly, confidently, because he's prepared. Tell me, have you ever noticed how the best trades seem to come when you're calm and everything just lines up? That's not coincidence. That's preparation. Prediction makes you emotional. Preparation keeps you objective. When you predict, you tie your ego to the outcome. You start rooting for your forecast instead of reading what the market is actually saying. You start defending your bias. The market doesn't care about your opinion. It only responds to behavior. The trader who predicts gets trapped by his own expectations, while the trader who prepares adapts. He has plans for both outcomes. If the market goes up, he knows where to act. If it goes down, he knows where to cut. Accuracy in trading doesn't come from knowing the future. It comes from being ready for either side of it. Preparation means knowing your levels before the market opens. It means studying the prior day's action, identifying where buyers stepped in, where sellers took control, and where the balance might shift next. It means writing down scenarios, not guesses, but reactions. If price breaks this level with conviction, I'll enter. If volume fades, I'll stay out. This kind of preparation builds confidence.